This is question number 11 on our assessment test. So this is a very comprehensive question about the estimation of weighted average cost of capital and valuation of a project. Someday incorporation is deciding whether to undertake a new project. The project is expected to be riskier than the firm's current operations. For cost of capital estimation, management wants to use the subjective approach and add 3% to its weighted average cost of capital of the firm. So from this sentence, we can infer that um, the weighted average cost of capital of the project will be 3% plus the weighted average cost of the capital of the firm. But from the study of the session, we should know that what matters for the project is the project weighted cost of capital rather than the firm cost of capital. So once we know the firm cost of capital, we should add 3% to that to get to the project cost of capital. The new project is expected to generate free cash flow of $1,200,000 by the end of the first year, and the cash flows are projected to grow at a rate of 3% per year thereafter. So it doesn't mention the end date of the project, hence we should assume that the project lasts forever. It requires an initial investment of $9 million. The current capital structure of the firm is as follows. Debt, 1-year annual coupon bond with coupon rate of 4%, $110,000, 10,000 shares outstanding, par value of $1,000, selling for 95% of par. Common stock, 1,100,000 shares outstanding, selling for $110 per share. From these two conditions, we can get the market value of common stock by multiplying the shares outstanding and the price per share. On the balance sheet, the stockholders' equity is $5 million. The beta is 0.8. So this sentence, stockholders' equity, basically tells us something about the book value of equity, but from the session study, we should understand that in order to estimate cost of capital, what matters is the market value of equity rather than the book value of equity. So we should, if we want to estimate the equity value ratio, then we should use the product of the shares outstanding and the price per share rather than the stockholders' equity. And the same is true for the debt. So the par value here is like the book value of the equity, book value of debt. But what matters is the market value of the debt. So we should use the price, which is 90% of par, and multiply by the shares outstanding to get the market value of the debt. Market, 7% market risk premium. Notice here it says 7% is the market risk premium. And market risk premium is defined to be the market expected return on the market and the risk-free rate. So we should not further subtract the risk-free rate of 7% from 7% again to get the market value of to get the market risk premium, because market risk premium is what we need in order to calculate the cost of equity in if we want to use the capital asset pricing model, or CAPM model. The corporate tax rate is 21%. Answer the following questions. So this 21% is like the current tax rate after the 2017 tax reform. The pre-tax cost of debt of the firm is. So the pre-tax cost of debt is basically the yield to maturity of the bond. So given the characteristics of the bond, we should be able to calculate is its yield to maturity. So B here stands for the bond. So let me list the characteristics of the bond. So this is the annual 1-year annual coupon bond. So that means we should this is a 1-year annual coupon bond. So from that we can tell the so here the characteristics is this is a 1-year bond, 1-year bond. So yield maturity is maturity, and it doesn't mention whether this is semi-annual bond. So we should assume, oh, this is the annual coupon bond. So maturity is 1, and coupon payment is the 4% multiplied by the par value, right? The par value. So why don't we write the par value first? So par value. So sometimes you may not get this default value of $1,000. So even though the most common case is 1,000. So the coupon again is 4% times this $1,000, right? So and shares of and the price is simply the 95%. It's 95% multiplied by the par value. So it's this one. So here we can use YTM function, which is rate function, YTM yield to the maturity, which is the rate. So the first argument here is the number of period. So here is the maturity. So that's this one. And then the second argument is payment here. The payment is simply the coupon payment. But here what we need to, if we go on this arguments, the third one is the PV, which is the current price, and the fourth one is the future value. So the rule of the using of the rate function is that we need to keep either payment and future value as positive and present value as negative, or we can keep payment and future value as negative and present value as positive. So here I choose to keep payment, the coupon payment, and future value as positive. Hence, I need to make the price as a negative number. Otherwise, the YTM or rate function will not be able to give me an answer. So the future value is simply the par value. And so we need to be careful about this rounding requirement because this is you can see the default. If I click on the format, the percentage here I only kept 0% or zero number of decimal places. That's why it shows as 9%. But if we go back to the question, we can see that the question asks us not to round intermediate calculations. Enter your answer as a percent rounded to 2 decimal places. So we need to keep 2 decimal places and use a percent. So this is the final answer, 9.47. And after tax, YTM. So that's basically YTM is the pre-tax cost of debt, and part B, the cost of why don't I just calculate the after-tax YTMs? Because later on, when we want to calculate the weighted average cost of capital, we need to use after-tax YTM, right? So that equals this YTM times 1 minus the tax rate, right? The tax rate here is 21%. So that's going to be my after-tax YTM. So, and then we get to the equity part, the S, the stock. So equity part, the cost of equity here, the information provided is, we know the beta, right? We know the beta. Beta is 0.8, and we know the market risk premium, which is RM minus RF. That's the 7%. And we know the risk-free rate. Risk-free rate is here the 7% too. So then we can use the campaign model, right? The campaign model says that the cost of equity equals the risk-free rate plus beta times the market risk premium, right? That's the campaign model. So then we can just plug in the number. So and the RS, this is RS. So that equals RF plus beta times this Rm minus Rf. Again, we need to change this format, this percent, but only keep two decimal places as required by this rounding requirement. The cost of equity of the firm, so far well, everything is about the firm, right? 12.60%. And then the debt value ratio used in the calculation of the weighted average cost of capital of the firm is, again, as we mentioned, we need to use the market value based on numbers. So about this B and S, the debt shares outstanding shares is as provided is that we have 111,000 shares. 111,000 shares. So it's I don't want to keep this to be percent, so just use the number. So 111, oh sorry, it's a 110,000 shares, and the price is, so the market value of B, that's simply the price times this shares outstanding. All right, that's the market value. And for equity, the shares is right here. Shares is 1,100,000. Yeah, and price, the price is simply 110 dollars per share. Again, we should ignore the information about the stockholders' equity because that's the book value of equity. So market value of S, so that's equity, that's simply the shares outstanding times the price per share. So now the B over B plus S, the market value based debt value ratio will be simply market value of debt over market value of debt plus, notice I added the parentheses, otherwise it will do the division first. That's what we don't want to do. And plus the market value of equity. So back to the rounding requirement. So here we need to round again as a percent rounded to two decimal places. So we need to change this format and use percentage terms and round to two decimal places. And S over B plus S, the equity value ratio, which is simply 1 minus this debt value ratio, right? So that's, so now going back to the connect 46.34, that's the debt value ratio, and the corresponding equity value ratio is 53.66%. The weighted average cost of capital of the firm is, so far everything is about the firm, and we have got the after-tax cost of debt, which is after-tax YTM, and we also have the RS, cost of equity, and we know the equity debt value ratio, equity value ratio. So now we can calculate WACC of the firm, right? So WACC of the firm, if we write down the formula, is simply the WACC. It's B over B plus S, and 1 minus tax rate times RB. So this is the cost of equity, cost of debt. So this basically is YTM, and this 1 minus tax rate times RB or YTM is simply the after-tax cost of debt. So B over B plus S is also calculated plus S over B plus S times RS. So that is the formula for the weighted average cost of capital of the firm. So given that, we can just plug in the numbers. So it's the B over B plus S times the after-tax YTM, and then plus the S over B plus S, the weight on the cost of equity, and then times the cost of equity. So then it's again format cells and keep only 2 decimal places before the percentage sign, so it gives us 10.23%. So this is 10.23%. And then part E, the cost of capital of the project. So this 10.23% is the cost of capital of the firm. And in the setup, we are told the management wants to use the subjective approach and add 3% to its weighted average cost of capital of the firm. So now, since we know the weighted average cost of the firm, we can just add 3% to this 10.23%. And so that naturally gives us 13.23% as cost of capital of the project. So cost of capital is a very important variable because it's a discount rate we need to use in order to discount future cash flows and get the value of a project. And that's the final part of this question. The net present value of the new project is. So net present value is what? Is defined to be basically the net present value is present value of all future cash flows minus initial investment, right? So initial investment here is provided to be $9 million, and future cash flow is the first year. By the end of the first year is $1,200,000, and each year the cash flow will grow at 3% and forever. So basically, this is the growing perpetuity. And present value of a growing perpetuity is simply the first year's cash flow divided by the discount rate and then minus this growth rate of the cash flows. So writing that down in the formula, so this present value or future cash flows is simply cash flow 1 divided by RWAC. Notice here we need to use the project, very important. Otherwise the number will not match. Project. Here it's the firm, but we have figured out the project weighted average cost of capital. And then minus, let's call that G, right? The growth rate of cash flows. So G here is given to be 3%. This is 3%. And this is given to be 13.23%. If I remember that correctly. So let's go back and check. Yes, 23%. Again, even though I wrote down number like this, but in actual calculation, we shouldn't simply use this number because this is a rounded number. And you can read the rounding requirement, which says do not round intermediate calculations. So But here I just wrote like this because I want to show you where the number came from. So cash flow one is the cash flow for the first year. That's $1,200,000. So let's go back and verify whether that number is correct. Yes, $1,200,000. So that's how we can get the present value of all future cash flows. And initial investment, again, that's being told by the setup. So now we can calculate this NPV. NPV is simply the 1,200,000 divided by this WAC firm. Again, this is only WAC firm. And then we should add 3% to that. So that's the WAC of the project. And then we should subtract the G, which is 3%. All right, so and then so far that's the present value of all future cash flows, and then we should subtract the initial investment, which is $9 million. So everything is in dollar terms, so we should convert 9 million into 9,000, 9 million in dollar terms rather than the million dollar terms like this one. So, and then the final rounding requirement here, it's round your final answer to 2 decimal places. So we need to change the format again, and rather than using percentage, just use the number and keep 2 decimal places. So then we can just copy this number back to the Connect. So now let's check our work. All right, good job.